Dear friends, welcome back to yet another important session on the subject financial management. We are discussing about the fourth module, leverages. In the previous sessions we discussed about operating leverage, financial leverage and combined leverage. We have seen the formulas also for operating leverage. I hope you are remembering the formula to calculate operating leverage and the concept of operating leverage. Operating leverage is equal to contribution divided by EBIT. This is operating leverage. Financial leverage is equal to EBIT divided by EBT. Then combined leverage is equal to operating leverage multiplied by financial leverage, or combined leverage is equal to contribution divided by EBT. In the last class we discussed how we got contribution divided by EBT. Combined leverage is equal to operating leverage, that is EBIT multiplied by financial leverage EBIT divided by EBT. So, now this EBIT and this EBIT will get cancelled. So, we get contribution divided by EBIT. So, these are the formulas we have seen for operating leverage, financial leverage and combined leverage. So, now look into this example illustration given. Just go through this illustration, then we will solve this problem. Yes. So, this illustration says that a firm's details are as under: sales at the rate of 100 per unit, 24 lakhs rupees. So, of course, if you want to know the number of units sold, 24 lakhs divided by 100 rupees, we get the number of units sold. Variable cost is 50% of sales, that means 12 lakhs. Fixed cost is 10 lakhs. It has borrowed 10 lakhs rupees at the rate of 10% per annum, and its equity share capital is 10 lakhs rupees, 100 rupees each. So, 10 lakhs divided by 100, we get how many number of equity shares are issued. Consider tax at 50%. You are asked to calculate operating leverage, financial leverage, combined leverage, then return on investment. And also the problem asks, if the sales increases by rupees 6 lakhs, what will be the new EBIT? So, these are the questions needs to be answered. So, for that you know about the formulas. Let us see how this is calculated. So, from this information, for calculating operating leverage, we need to estimate contribution and also we need EBIT, earnings before interest and tax, or operating profit. Contribution is equal to, sales minus variable cost. Sales is 24 lakhs, variable cost is 50% of it, that is 12 lakhs. So, contribution is 12 lakhs. Then EBIT, operating profit, is equal to sales minus total cost. Sales minus total cost, sales is given, sales is 24 lakhs, total cost is equal to variable cost plus fixed cost. Fixed cost is 10 lakhs, variable cost is 50% of this, that is 12 lakhs. So, 12 plus 10, 22 lakhs rupees is the total cost. So, 24 minus 22 lakhs, we get 2 lakhs rupees as the EBIT. Then from that EBIT 12 lakhs, what needs to be deducted? Interest needs to be deducted, EBIT minus interest. How much is the interest? 10% of 10 lakhs rupees is the interest, because borrowed fund is 10 lakhs at the rate of 10%. So, 10% of 10 lakhs needs to be deducted as interest, then we get earnings before tax. So, with that information we can calculate financial leverage. Then to find out return on investment, then what has to be what needs to be calculated? Profit after tax we need to calculate. For that, from that earnings before tax 50% tax to be deducted, then we get then we can calculate a return on investment. Here one calculation is given, the same thing what I explained is given. Sales 24 lakhs. Yes, dear friends, now you can see how this leverages are calculated. So, we are discussing that 24 lakhs rupees is the sales and 50% of that is variable cost. So, 12 lakhs rupees is deducted. So, when we deduct 12 lakhs from 24 lakhs, we get 12 lakhs as contribution, sales minus variable cost, 12 lakhs as contribution. Then from contribution, when you deduct fixed cost, because we know sales minus total cost is operating profit or EBIT, earnings before interest and tax. So, from sales we deducted variable cost, sales from minus variable cost we got contribution. So, contribution comprises of fixed cost plus profit, that we know. So, from contribution when we deduct fixed cost we get EBIT. So, we got the EBIT as 2 lakhs. So, EBIT is 2 lakhs. So, from EBIT, earnings before interest and tax, in this case there is borrowed funds. Borrowed funds, it is mentioned that it has borrowed funds of 10 lakhs rupees at the rate of 10% per annum. So, interest is 10% of 10 lakhs, that is interest 1 lakh rupees is interest. So, 1 lakh rupees interest is deducted from earnings before interest and tax. From EBIT, when we deduct interest we get EBT, earnings before tax. So, we got earnings before tax as 1 lakh. And tax burden of the company is 50% is mentioned. So, 50% of earnings before tax has to be paid as tax. So, less tax, 50% of EBT, 50% of EBT, that EBT is 1 lakh. So, EBT is 1 lakh, 50% of EBT 1 lakh, that is 50,000 rupees is tax. So, when we deduct tax from EBT we get earnings after tax, earnings after tax is 50,000. Then number of equity shares, already mentioned how to calculate number of equity shares. Here its equity share capital is 10 lakhs, each share cost 100 rupees. So, 10 lakhs divided by 100, that is number of equity shares we get. So, number of equity shares 10,000. No, correct is that. So, 10 lakhs it is 10 lakhs divided by 100 we get 10,000 equity shares. So, number of equity shares are 10,000. So, this earnings after tax, earnings after tax. So, after paying all taxes, earnings after tax is 50,000 rupees. Number of equity shares are 10,000. So, earnings after tax divided by number of equity shares, that is number of equity shares 10,000 is equal to 5 rupees, rupees 5 is this 5 rupees is EPS, earnings per share. So, why earnings per share is calculated? The reason is return on investment is asked. Return on investment means return on investment. Who invested? Invested by the equity shareholders. What is the return the equity shareholders are getting? So, return on investment is equal to earnings after tax divided by number of equity shares. So, return on investment is nothing but earnings per share, that is 5 rupees, it is calculated. Now, based on this information we can calculate operating leverage, financial leverage and combined leverage. Operating leverage is equal to contribution divided by EBIT. Now, in each information you can take, see contribution is 12 lakhs, sales minus variable cost. Contribution is 12 lakhs divided by EBIT is 2 lakhs. In the same way, financial leverage is equal to financial leverage is equal to, just recall the formula, all the three formulas I mentioned: operating leverage, financial leverage and combined leverage. If you are able to recall, you please recall the formula for financial leverage. Operating leverage is contribution divided by EBIT. Financial leverage is EBIT divided by EBT. Financial leverage is equal to EBIT divided by EBT, and combined leverage is equal to operating leverage multiplied by financial leverage, or it is equal to contribution divided by EBT. So, now you can see EBIT is equal to EBIT is equal to 2 lakhs divided by EBT is 1 lakh. Now, combined leverage is equal to contribution, that is 12 lakhs divided by EBT, that is 1 lakh. So, this is how it should be calculated. In detail calculation is given here. Now, you can see operating leverage is equal to contribution divided by EBIT, contribution divided by EBIT. So, 12 lakhs divided by 2 lakhs, it is operating leverage is 6 times. Financial leverage is equal to EBIT divided by EBT. EBIT is 2 lakhs divided by EBT is 1 lakh. So, financial leverage is 2 times. Combined leverage is equal to operating leverage into financial leverage, 6 into 2, 12 times, or combined leverage is equal to contribution divided by EBT. So, we get 12 times. Then return on investment is 50,000 divided by 10 lakhs into 100, that is 5%. What is that 50,000? 50,000 is earnings after tax. Earnings after tax is 50,000. So, earnings after tax divided by amount of equity shares. Here we calculated earnings after tax divided by number of equity shares, we get earnings per share, returns per share, earnings per share. Return on investment is equal to earnings after tax divided by amount invested by equity shareholders. Amount invested by equity shareholders is 10 lakhs rupees. So, return on investment is equal to earnings after tax, that is 50,000 divided by yes, dear friends. So, we were discussing about return on investment. Return on investment is equal to earnings after tax or earnings available to equity shareholders divided by amount of equity or amount money invested in equity, amount of equity, that is 10 lakhs rupees into multiplied by 100. Multiplied by 100, we get 5% is the return on investment. The equity shareholders are getting 5% return for their investment. So, how this ROI is calculated is mentioned here: earnings after tax minus preference dividend divided by equity shareholders funds. So, here in this illustration there is no mention about the preference shares. So, since preference shares are not mentioned directly, earnings after tax, from earnings after tax we have taken, earnings after tax 10,000 we have taken, that divided by equity shareholders funds. Equity shareholders funds, it says that it equity shareholder share capital is 10 lakhs rupees. So, earnings shareholders funds is taken, then we got the return on investment as 5%. In case if preference shares are issued and if there is a mention that preference shares are issued, then in such cases, now this earnings after tax, from this earnings after tax amount we have to deduct preference dividend to preference shareholders has to be deducted in case if it is mentioned, but here in this case it is not mentioned. So, that is the reason why straight away earnings after tax is taken, divided by shareholders funds, we get return on investment. So, that is what we calculated, return on investment is calculated. Now, I hope it is clear to you the calculation of operating leverage. Operating leverage is equal to contribution divided by EBIT, then financial leverage is equal to EBIT divided by EBT, combined leverage is equal to contribution divided by EBT or operating leverage multiplied by financial leverage. Okay. So, I hope this illustrative problem is clear to you. Now, next we will solve another problem on operating on leverages, then this topic will be very clear to all of you. So, the data relating to two companies are as given below. You are required to calculate the operating financial combined leverage of two companies. So, here the information is given with respect to company A and company B. Equity capital 12% debentures, debt to capital borrowed funds, output in unit per annum, number of units is given, selling price per unit is given. So, number of units output or number of units output multiplied by selling price, we get the sales revenue. Then fixed cost per annum is given, then variable cost per unit is given, variable cost per unit is given. So, that means output, this output multiplied by selling price, we get sales revenue. Sales revenue, from this sales revenue, this output multiplied by variable cost, we get the total variable cost. Then fixed cost is given 7 lakhs rupees. So, fixed cost 7 lakhs rupees, and then variable cost we get this output multiplied by variable cost, we get total variable cost. Then we can calculate contribution, this sales revenue minus variable cost, we get contribution. Then from that contribution, if you deduct fixed cost, we get the EBIT. Then from EBIT, 12% debentures, 12% of 4 lakhs, if you deduct, that is interest, if you deduct, then you will get EBT. So, from EBT, earnings before taxes, here nothing is mentioned about taxes. So, if tax is there, tax has to be deducted. if tax information is not given, you can leave it, or you can assume there is a tax and the tax you can deduct. Okay. So, let us see how this problem is calculated. First of all, an income statement, as I mentioned earlier, sales revenue is calculated. How sales revenue is calculated? As I mentioned earlier, output is 60,000, selling price is 30. So, in this company A, output 60,000, selling price is 30. So, 60,000 into 30, that is 18 lakhs rupees is the sales revenue, whereas the company B, selling price is 15,000, output is 15,000, selling price is 250. So, 15,000 multiplied by 250, that is 37 lakhs 50,000. So, that is selling price. Then variable cost already mentioned. Variable cost is company A 10 rupees, company B 75,000. So, variable cost of company A is 60,000 into 10. So, this is 60,000 into 10. Company B output is 15,000. Variable cost per unit is 75 rupees. So, 15,000 into 75, 11 lakhs 25,000. So, from sales variable cost has to be deducted. So, 18 lakhs minus 6 lakhs 12 lakhs, then 37 lakhs 50,000 minus 11 lakh 25,000, you get 26 lakhs 25,000 as contribution. So, sales minus variable cost is contribution. Then fixed cost is given. Fixed cost is given in the problem. Fixed cost, first company 7 lakhs, company B it is 14 lakhs. So, straight away fixed cost remains the same. So, 7 lakhs and 14 lakhs rupees fixed cost. So, from contribution fixed cost has to be deducted. So, from 12 lakhs 7 lakhs rupees fixed cost, when we deduct, we get 5 lakhs rupees as EBIT, 5 lakhs rupees EBIT. In the same way, 26 lakhs 25,000 contribution, from that fixed cost of 14 lakhs of company B is deducted. So, we got 12 lakhs 25,000 as EBIT. So, this is the EBIT of company B. Then from EBIT, what has to be deducted? Interest has to be deducted. What is mentioned about interest? Company uses borrowed funds, debentures, 12% debentures. Company A uses debentures of 4 lakhs. So, 12% of 4 lakhs, 12% of interest, 12% of 4 lakhs, that is 48,000. Then with respect to company B, the amount of debenture is 6 lakhs 50,000. So, 12% of 6 lakhs 50,000, that is 78,000 rupees is the interest in company B. So, this from EBIT, interest needs to be deducted. When you deduct from interest from EBIT, we get 4 lakh 52,000 and 11 lakhs 47,000. That, what is that? When you deduct interest from EBIT, we get EBT, earnings before tax. So, we got earnings before tax of both the companies. Now, you can calculate leverages. Operating leverage is equal to contribution divided by EBIT. Contribution divided by EBIT. How much is contribution for company A? Company A, the contribution is 12 lakhs. 12 lakhs. Contribution is 12 lakhs. Contribution divided by company A's EBIT is 5 lakhs. 12 lakhs divided by 5 lakhs is operating leverage for company A. Operating leverage company A. So, 12 lakhs divided by 5 lakhs is 2.40 times is operating leverage. Same company B's operating leverage, contribution of company B 26 lakhs 25,000 divided by contribution divided by EBIT. EBIT is 12 lakhs 25,000. So, 26 lakhs 25,000 divided by 12 lakhs 25,000, the operating leverage is 2.14 times. So, both the companies operating leverage is calculated. In the same way, financial leverage needs to be calculated. Financial leverage of company A is equal to, the formula is financial leverage EBIT divided by EBT. So, company A's EBIT, is 5 lakhs rupees, company A's EBIT 5 lakhs rupees. So, 5 lakhs divided by company A's EBT is 4 lakh 52,000 is equal to 1.11 times, 1.11 times. In the same way, company B's EBIT, company B's EBIT of company B is 12 lakhs 25,000 divided by EBT of company B 11 lakhs 47,000, is equal to 1.07 times. Now, combined leverage is equal to, either we can take combined leverage of company A is equal to 2.4 into, that is operating leverage of company A into financial leverage of company A, is into 1.11. Then with respect to company B is concerned, for operating leverage of company B, operating leverage of company B 2.14 multiplied by financial leverage of company B, that is 1.07, we can calculate, or we can calculate combined leverage as contribution divided by EBT. Combined leverage formula is equal to contribution divided by EBT. So, if you calculate in this way, you will get the same answer. For company A, contribution you should take, contribution is equal to 12 lakhs divided by EBT 4 lakh 52,000, and same way for company B, contribution 26 lakhs 25,000 divided by EBT of company B 11 lakhs 47,000. This is how the leverages are calculated. It is very easy to calculate operating leverage, financial leverage and combined leverage. It is very easy to calculate. Hope it is clear to you, and you will get more problems and solutions in the study material which is uploaded. So, go through the study materials also and practice more problems to get well versed with this topic. So, with this we will conclude this calculations on operating leverage, financial leverage and combined leverage. In the next session we will discuss about further things about leverages, that is impact of leverage we will discuss in the next session. Thank you.